right, so I think we're going to want to start right on time since we're doing the online thing, right? There's a cocktail party going on, so that's always stiff competition. But we're going to start in, and I'll start by telling you that I accidentally wound up at the LED convention upstairs. So that was fun. I was wandering around the trading, the exhibit hall, looking for the on-camera interview they wanted to do. So got some weird looks up there. But what we're going to talk about today is first hour trading. So how many of you guys trade equities? Cool. Okay. How many of you intraday trade? Day trade. Oh, perfect. Okay, so if you are watching online, oops, hang on a second. And then give me 2 seconds here. There we go. All right, if you're watching online, then you can get the same deal as the folks who are here. Just go to that registration link. It's traderinsight.com/expo. And what we're doing is you'll get a copy of the presentation and a PDF download of all of our first hour trading. So we've got actually 3 strategies that we use in the first hour of the trading day, each and every day. We've been using them for 22 years now. And you know, you're going to see here that they play out really well. What we're going to cover today is a gap trade. But you'll get access to all the services and everything that I put out on the site for 2 weeks. If you log in at least 3 times a week to retrieve the stuff, then we'll extend it to a full month. And you know, just make sure you give us your email address. If you're filling out the cards here, make sure that email address is legible, like machine readable. And that your name and your phone number and everything are easy to read. We'll give you a call and just make sure we walk you through the site real quick, and that you don't have any questions, and then you're good to go. So, you know, if you're trading intraday, it would behoove you to be in that first hour trading pit. Those guys in there are all trading for a living and have all been doing it for, you know, going anywhere from 3 to 7 years or so. So it's an interesting group of people, and they're all talking about the same trades. We've all got the same trades in front of us every day, and we're all focused on exactly the same information. So it's not one of these, hey, this is coming up on an entry. Entry's coming up. If it comes up on 50% of the target, here's where our money management rules come into play. So everybody's just sort of helping everybody out in that room. When I say us, that is Julie. You've met her. She's the back of the room there. So Julie and I started doing these trades. We were in graduate school. So we were both working on our PhDs, MBA, PhD, and what we were doing was crunching a bunch of financial markets data, looking for an edge in the markets. Is there an edge in the markets was really what we were trying to get at. So over the years, we took a lot of market data and created a system that goes through and handicaps things. So today we're going to talk about an opening gap trade that has a 95% confidence interval, right? You've got a 95% probability that the gap extension is significant enough that you're going to move back towards the mean. Most guys who trade gaps, very frustrated with them because what they're doing is, I'm just going to look for a gap and go, or I'm going to look for a gap that fails, and I'm just going to trade it whichever direction it goes first. This thing that I'm going to show you today is very, very methodical, and it's based on inferential statistics. It's a model that you know, has worked for us from day one, and I recorded a live trade today. There were 2 trades available. I recorded them. I brought them with us. We're going to go through them. So after I show you how to do them, we'll go through and see if you can walk through, you know, how you would handle the entries and exits. So over the years, you know, in addition to, I've been at every Traders Expo since the first Traders Expo, if you can believe that. We've also published all of these ideas in you know, industry journals, industry magazines. Popular Press has done a bunch of stuff on us as a trading team. We're interesting to people because we're a husband and wife trading team, and we haven't killed each other in 22 years. But You know, a lot of this stuff is out there for people to look at. I don't believe in doing black box kind of stuff. I like to, you know, I like to put the proof in front of people, show them exactly how something works. I think that if you go and trade something that you don't have a fundamental knowledge of, you don't understand why it's doing what it's doing, I think you're nuts, right? You have to really get at why something is happening and agree with the fact that maybe it should be happening before you go and put your money behind it. So that's always been the philosophy. The stuff we're going to talk about today actually goes back to the first book that I wrote, which was Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. And I always tell people that book was the product of a bunch of research in graduate school and was originally called A Multivariate Analysis of Covariance in the U.S. Equities Markets, right? And my publisher said, how many copies of this thing do you think your mom's going to buy? Because it's not going to fly off the shelves. So we reworked it into a baseball analogy, right? So if you've got that book, or if you're familiar with the terms in there, then you know that there's like, you know, fastball expansion of range and volume setup, or an infield fly reversal setup. All those things are just really good metaphors for a chart pattern that has its roots in a really grounded statistical pattern. But that was the basis for everything that we do, and it still is the basis for everything that we're doing. So the patterns that were in that book are the ones that were really the foundation for, you know, what became our trading business. So today the focus is going to be on a 2 standard deviation gap reversion trade that I developed. This was, you know, my big project. It's the equivalent of, you know, my Bollinger Band, if you will. This is something totally different than what most people have been doing over the years with gaps, and it's got a really, really high probability of success once you get into it. So this trade started, when we first started doing this, what we did was took the implied volatility of the front month contract for any particular equity, right? It was the S&P 500, S&P 400 really was what we were scanning for. And every night we had to go and load all this data in so that we could then the next morning figure out, was a gap significant. Today what we do instead is use true range, because true range wound up being a really good proxy for volatility. So true range is different than range, right? Range is the high minus the low on a given trading day. True range includes a gap. So it goes through and it figures out how much on average is a stock gapping over time. So stock's true range is just the greater of either the high minus the low, the traditional range, or the absolute value of the high minus the previous close, or the absolute value of the low minus the previous close, right? Absolute value, you're just getting rid of negative numbers. So, right, if this is a daily bar, and that's the high, and this is the prior bar, and that's the close, then your true range goes from that high at $50.10, the close the previous day, 59 bucks in this case, let's say $1.10 is the true range. And what we do with those numbers then is plug them into a statistic. So you're not going to have to do all this stuff, right? I just want you to know what it is that you're looking at when the scanner pops out the numbers at you. This is automated for us. It's automated, but this is what's happening in the background. We're working on the assumption market data is normally distributed. So Julie and I have done a ton of work over the years proving, right, market data is definitely normally distributed. We're also working on the assumption that true range is a proxy for volatility. So all the work we've done on volatility, we can show there's an extremely positive correlation between true range and implied volatility. Then the final assumption, volatility is mean reverting. And this isn't just me, this is, you know, experts going back 30 years will show you that volatility is definitely mean reverting. And what all that stuff does then is gives you access to this thing, and this is really where sort of the magic of what we're looking at with these opening gaps happens. That's the normal distribution. That line in the middle is the mean. That's just the average, the arithmetic mean. Out to the edges of those red zones, that's one standard deviation. That's 68.2% of the variability that we can expect to see. So standard deviation is just how much on average can we expect what we're looking at to move away from the average. So once you're out one standard deviation, you've seen 68.2% of what you expect to see has already occurred. Go out 2 standard deviations, now you're better than 95% of what you're expecting to see in the morning. So when we get a gap and we see that it's out 2 standard deviations in terms of the range that it's done for the day, we've got a 95% expectancy that we're not going any further before we make a reversion move. Doesn't mean we're looking to close the gap. It just means that before the distribution skews, before we have like new data points in this whole thing, before we make a move somewhere else, it's going to move back towards that average. And then what the spreadsheets are doing, or what the scanner on the site is doing, is it's just going through, taking that true range data for the past 10 days and plugs it into this formula. So it's just the standard deviation is just taking these 10 values, from each one it subtracts the average value. It squares that to get rid of the negative value, divides it by n, right, the number of observations. If you're a statistician or an engineer, you're looking at that saying that should be n minus 1. It's because it's a small sample size, it's just n. And then we get one standard deviation of 49 cents in this case. So if you have a 49-cent standard deviation, that's 1 SD. 2 SD, all the scanner is doing is multiplying that number by 2, then it adds it to the average, right? So in this case, you have 98 cents plus $1.25. So $2.23 is how much this stock has to gap. If it gaps $2.23, we're going to expect to see it move back towards the average, back towards the mean. And today, the one that we're going to focus on is, so I did a big course on this whole thing, and there's actually 4 different variants of an entry and 3 different variants of an exit. But I just want to go through the most basic one. This is sort of the bread and butter trade on this thing. If you've got, these are 5-minute bars, say, and right, these bars over here, this is going into yesterday's close, and then we get this gap open. And that gap open pops up on our scanner, and it says that we've got a 2 standard deviation gap in whatever this is, right? XYZ gap, 2 standard deviations. Then what we do is we're following this down bar by bar. So there's a long side trade because it gapped to the downside, and we're just looking for, okay, this on the first bar, this is the highest, or the lowest high, I should say. On the second bar, this is the lowest high. Third bar, this is the lowest high. Fourth bar, that's the lowest high. And we're treating this like a pullback. So if you guys are used to trading pullbacks and you're looking for the breakout of a pullback back in the direction of the trend, that's all we're looking for there. And once that deepest bar is in place, we look to get long on a 5-minute chart, just a couple ticks above that high, and then I'm always targeting something major that happened in the first bar. And I'll show you what I mean by that in a second. But it's always either the open, the close, the high, the low, big pocket of volume or something that we find in that first bar of trading. That's where we establish our price target. And all of this stuff is null and void at the 30-minute mark. So we only trade these for the first 30 minutes of trading. So it could wind up being the case that once the trade's on, it extends into the first hour. But if it didn't trigger in the first 30 minutes, then we start to assume that we're seeing a distribution that might be skewing, and then the statistic becomes less valid. It might still go, right? It might still go and hit a profit target. It might go and make a big move in your favor, but the statistic becomes less valid after that first half hour of trading is over with, so we cut them off at the 30-minute mark. So when you're in the room and you hear, you know, Rick Kipp is one of our alumni, one of our students from the second boot camp. He voluntarily moderates that room. Sometimes some of the other guys moderate that room. But he'll talk about, well, we're at the 10 o'clock mark, no more 2SD trades. That's what he's talking about. It's just that my model is most valid during the first 30 minutes. So that's why we're focusing on those. So we've got our scanner set up. You can do these also. You can, if you have TradeStation, you can configure radar screen to scan for these. If you're really good with Excel, you can just set up a spreadsheet using those formulas that I just showed you. If you're using Trader Insight and you want to subscribe to the gap scanner, whoops, there it is, it separates the S&P 500, the S&P 400, and the news gaps. So this thing populates like 2-3 minutes into the trading day. And that's plenty, because remember, you're looking for, maybe it's 40 seconds into the trading day, you're looking for that first bar to form and be in place before you're making any decisions. Then the next thing that we focus on is, so for my trading, like today, right, there were a bunch of them, but you can see over here, daily gaps from news, right? And in this case, DKS and SFIX are both in the news column, and they also have an asterisk next to them. And what the asterisk does is tells you its earnings. So you get all these gaps, and they're 2 standard deviations, but it's important to find out why the stock gapped. Okay, so this is a quick glance, automatically gives you access to, all right, it's a headline-driven trade, and it's on earnings. If you're looking at some of those other trades, it's a real good habit to get into. Pull up the fly on the wall, or pull up CNBC, pull up some kind of a news source and find out why the stock gapped, right? If the CFO or the COO or the CEO is sitting in a jail cell somewhere in Tijuana because he did something, then that's not a trade you want to take, because the distribution just skewed on you. If there's a fundamental change to what's going on with the company, it's not a valid trade. It might be a valid 2 standard deviation setup, but what you really want to focus on are just garden variety news on earnings, always overblown. Right? If you sat down, you do the math, it never makes sense for the stock to gap as high as it did. And then if you start looking at the upgrades and the downgrades, you find out the stock gapped exactly where it's been upgraded to, or maybe it's got 30 or 40 cents a room, versus what the analysts are saying. But these are the trades that wind up making these very nice reversion moves when we get into them. So before we look at the actual, the recording of a live trade, let's go and just look at a sort of a classic setup. Okay, so this was the other day, this was on Friday, I believe, this was Costco. So Costco gaps up, it's earnings news, it's expectations news, it pops up on our scanners, so we're immediately looking to see whether or not we've got an entry opportunity in this. So the first 5 minutes, right, first 10 minutes, first 15 minutes, actually you've got nothing going on, and then it starts drifting up into this range and you get these higher lows in place. So now you're always looking at it as if it's a pullback. Everybody knows how to trade a pullback, right? You're always trading the breakout back to your trend line. And as this moves up, what I'm doing is I'm placing a bracket order around the trade, and then I'm just going to jockey my bracket order as the stock keeps moving higher. So each time it doesn't trigger, I use a piece of software called RealTick. So that's actually how we got started teaching. My broker back then called us and said, hey, you guys are profitable. Do you want to, RealTick wants guys to go out and show people how to use the software. This was in, 1999, I guess. So when they were still focused on retail traders, I was sort of the RealTick spokesgirl, if you will. But in RealTick, what I can do is I can toss up a bracket order, and then I can just drag the line on the chart. So when the order populates, it puts a line on the chart, and then if I want to change my order, I can just pull the line and it goes to the next level, or I can clear the bracket and just use a quick macro, throws up a new bracket at that current low. If you're using TradeStation, if you're using TOS, if you're using any kind of piece of software, IB, all these pieces of software have functions like this that make it easy to change things on the fly. So sometimes we're watching 3 of these at a time. So if we're watching more than one of them, it's kind of important to me that I can change them quickly, that I can get the prices changed quickly. But you see it, right? As this thing is tracking higher, what we're doing is just constantly saying, okay, as long as we're within our time parameter, if it breaks down through that red line there, then it's a go. We're going to focus on getting in at that violation. We're going to put a threshold then, right, is right there for our entry. The stop on this initially would have been at that high of the bar that created the pattern. As soon as we're in and price starts moving in our favor, as soon as that thing's 50% of the distance to the target, I move my stop to the high of the entry bar. So we start ratcheting down on it. And we're always looking for a place that there's a lot of overlap with volume or volume by price. Out on the right side of the chart there, that's volume by price. So if you're over here, what that's telling you is for every single level that something ticks here, how much volume's going off. Whereas down here, this is volume by time, and it's telling you whether it's buy side or sell side volume. And what these levels do for me is just give me, earlier in the day, you're not going to have as much going on up here, right? Because the stock was trading in this range over the course of the session. But down here you can see, right, based on this opening data before it ever made the reversion move, we can see where there was a significant spike in your volume by price. And that tells us then where we can put a logical profit objective, because where it inflected before is where it's likely going to inflect again, right? If it caught a bounce there the first time, probably going to bounce the second time. So in this case, if you look at where that first bar closed, right, that's always going to be where I'm looking for the opportunity for a target. So either, right at an open, right at a close, a low, right? But I'm always looking over here to see, all right, well, what happened as it came in? So this, when you hear us talking about targets in the room, or when you see the charts that we've got up and we're talking about where we're going to place our exit on a trade, this is always there because of what's going on over here on this side of the chart. So here is how we would set up the position management on this. So now we know all the pieces are in play, right? We've got a short sale entry right below the low of that. If you've read Around the Horn and you're a fan of that book, that's also an infield fly pattern up there. It's got this reversal setup. We're going to enter the short right there. Our stop loss winds up being up above that entry bar high. Our target is down there right at the close of that first bar of trading. And then the way we set up the order is really pretty simple. So I just pull up a bracket order, right? I've got my stop price, 227.45, so that's the price I'm going to enter at, right? There's always a fair amount of confusion about, Realtek doesn't use the term activation. Realtek uses it's the floor trader terminology. I want to get in at 227.45 stop, and then my limit is going to be 226.85. That's the worst price I'm willing to accept. I base that on just what's the bid-ask spread look like, what's the typical tick look like, how much drift is there as we're trying to get into the position. Right? So I'm just sort of eyeballing this stuff as it goes by, making sure that I'm not setting that parameter too tight, but then at the same time, I don't want to set it too wide, because usually these things are bouncing around quite a bit. When it's time to get into them, they wind up bouncing right back into your entry. If you give it too much slippage, you're going to lose the slip, and then it's going to wind up right back where you could have got in to begin with. So it's better to set them up a little tighter. Then we've got down below here, right? There's your exit for a profit. So I take that 224.69 number that we had on the chart, I plug it in, and this is where your question from before comes in about the, how do you handle the exits if you don't get a full fill on the way in? You can see there we're exiting 100% of the position. So if we ordered up 1,000 and we got filled 450, or we got filled 650 or whatever, it's gonna close out the position for 100% of what our actual fill was on the trade. And then it also shows you, of course, so that's your potential profit on the trade, that's your potential stop on the trade. When I'm happy with my bracket, what I do is I go down to this area right here, strategy, and in this case, I would just call it COST. I would type in COST there, I hit save, and then if the stock continues to move higher or move lower, each and every time then that I go to place the bracket, all I have to do is load up COST, and it's automatically going to put in the parameters that I'm looking for. All right? Okay, so now again, this morning, we had 9 potential setups, and this is where people usually hang up with this stuff, right? Too much to look at. Sometimes there's 15 potential setups on there. And there's, the question that I get, because you guys are all welcome to call me after that first hour trading bit and say, I don't get what was going on there, why were you doing that? I take a hike every morning at 9 a.m. Pacific time, and that's usually when I like to talk to people. But if you've got a bunch of setups on the screen, and you've got 2 that have an asterisk next to them, and those happen to be in that news column, those are going to be the highest probability setups for an entry. So those are the ones that I focused on today, and those are the ones that, Rick and those guys, a lot of times you'll see they'll focus on some other stuff because they're looking to get in front of the opportunities. Julie and I, we just want to get in front of the best potential setups. I mean, it's been too long, right, for us that we're going to go chasing trades at this point in what we're doing. So before I pop the example up and we see if you guys can figure out the exits and everything, does anybody have questions about sort of what we covered so far? So the gap is going to be on an intraday 5-minute chart. So I do all my trading from 5-minute bars. I think, 1s and 3s are too noisy, and especially the volume by price data gets a little bit difficult to interpret. A 5-minute chart is sort of in the sweet spot over there. Like a 10-minute chart is too far out because it winds up eating up too much of the reversion before you can get into the trade. 5-minute chart has been the sweet spot for us with this trade. Anybody else? Yeah.
Why do you use a line graph instead of like a candlestick?
Well, that's been an argument in our house for 22 years. She uses a candlestick in her trading. I have always found, like for me, right, that when I look at this stuff, just an open, high, low, close bar chart makes it very easy for me to see what's going on. And I think, right, so both of us we're both psychologists, right? Our PhDs were in psychology. And what I'll tell you is the worst thing you can do trading is trying to force yourself to do something that's not in your comfort zone, right? Because it's a, I've got one guy who, we screen really heavily for this boot camp that we do, right? We really make sure that the people who are going to this thing are in tune with us and in line psychologically and, in sort of the same space with what they expect from trading. I've got a friend who I grew up with who, just absolutely wanted to go, and we probably should have told him it was a better idea for him to find something else to do, right? Because he's just not, he's sort of a gambler, and we're not gamblers, right? We're handicapping statistically what goes on in the markets. And every day he tries to bang out these trades in Apple because he likes the action in Apple. And every day he winds up losing money on those trades, and he's forever, just angry at Apple. He's always revenge trading, right? Which is like the worst thing in the world that you can possibly do. He'll make money with our XRV trades or with the opening gap trades, and then he turns around and I just tell him, I said, John, close the computer. Walk away from the machine. You're done. You made money. You're good. That's it. And then 4 hours later, I'll get an email. Well, I lost $1,300, $1,400 trading Apple. Here we go again. And what I come around to is it's really not his psychological sweet spot like our stuff works for him, but that's not what he's looking for, right? He wants to be real active. We're not real active, right? So our trades, we do probably, we're probably doing 40 trades, round trips a week if we're doing a lot. I've looked at his chart. He said to me, well, I don't understand why I'm down. And I'll say, well, John, we're 4 bars into the day and you did 77 trades, right? Tell me when I sound out of line here. This is not a logical plan for how to trade the markets. You're over trading. So for me, open, high, low, close chart is just what's comfortable. She likes the candlestick charts, and it's sort of the end of the discussion at our house. We don't, it's whatever works for you works for you. Somebody else? Yeah.
Do you ever use a market order? Do you think that can be utilized in like a small cap or something you can't really get filled in the limit?
So I don't ever use market orders, okay, but that's because we have very good knowledge of, we've worked with a lot of market makers, we've worked with specialist firms, we've worked with $2 brokers over the years, and it's more about, we use marketable limit orders. So if what you do is you send out a market order, especially on some of the stuff that has lower liquidity, then what you tend to find is your market makers see this coming and they back away, and then you wind up with a fill that's down at the bottom of the range, right? So let's say you're quoted to 55 spot 01 by 55.20, and you go put in a market order. It's almost never the case you get filled at 55.19, right? You always get filled down at 01. Whereas if you do a marketable limit order and you're watching what's happening on the ticker, So I'll do I'll watch in real tech, I'll watch for the irregulars to go by. I want to see where the bulk of the trades, because on a low cap, or a small cap stock, a lot of what you tend to see are a lot of irregular trades, right? 50 shares, 100 shares, 27 shares, 70 shares. If you turn on irregular trade monitoring on your ticker tape and you can see those going off, you get a real good idea of where you have to set that limit. So maybe if it's 01 by 20, instead of saying get me in at the market, you say, you know what, I see a bunch of trades going off around 14, and now you put out a limit order that says, I want to get in 55.20 stop, 55.13 limit. You've narrowed, you're still marketable, right? You're essentially a market order. You're just a market order down to 13, and you're not going to get this like walk away kind of a thing. So we find that we get filled faster on those marketable limit orders than we do with market orders, and I will tell you that my aforementioned friend John does a lot of market orders on Apple, and even on Apple he's getting very big slips, right? And Apple's trading penny spreads. By the time his market order hits the tape and gets executed, he winds up getting 5 or 6 cent slippage, and what he's trying to do are these micro scalps where he's pulling 10 cents out of the market. You can't slip a nickel, right? So if you bracket it up and you keep it tight, I think you're going to get better fills on these. Somebody else? Yeah.
Through your research, this concept I heard about, kind of like the boogeyman out there. You put a stop out there, market makers see it, hit your stop.
So market makers aren't, I mean, they're not out there gunning for stops necessarily. It's just that they know where the stops are, because most people put their, so like one of the things that we do at the boot camp that we do is we have guys go through and just draw the lines, right? So, okay, where's support? Where's resistance? And what we find is people will look at those lines and then they'll set a hard stop right there. And that winds up being where a lot of these sweep orders hit and take you out at the stop. Whereas when we're setting stops, we'll find support and resistance, and then we go beyond that to where there was no order flow, right? And then you wind up eliminating. So when you guys are on the site and when you're using the service and you're looking through, so there's a trading plan that I've got on the site called the Around the Horn plan. That's got data all the way back to 2006. Every trade we ever planned, published, entry, exit, right? Whether it's for a profit or a stop, there's a spreadsheet of every single one of those going back to 2006, and you can look at them, and if you do your homework and sort of drill down on, okay, what's he doing, you'll see that those stops are always sort of right around where support and resistance are, but they're beyond, whereas the targets are always right at support and resistance. And if you go through and look at all that data, right, going back 13 years that we've been publishing it, I've had people say, your exit orders for a profit are exactly where the market turns around, right? And I'm like, well, that's because that's the true support line. That's where there's a bunch of order flows sitting, and when we hit that number, pops back in the other direction again. So, Julie and I had long conversations when we first started doing this about, okay, well, when you're setting a stop, make sure you're not actually setting a target. Make sure you're not setting the spot that the thing's going to bounce. We're always posting where we're going to take a profit. So if the hard support line on my trading plan is again $50.20, then what I'm doing is I'm usually, my targets that you'll find on that plan are going to be just a penny or two shy of where that actual support number is. And then what I do is I put my order out there as a limit order before the actual target, right, or before where that line would be. The target on the plan is a couple pennies early usually, because I'm expecting the order flow to make it through there. And once it gets through there, I'm expecting it to exhaust and head back in the other direction. Yeah. Right. Well, I mean, we don't trade that many. So the question is, based on share size, how much can you expect to get filled? So most stuff today on the exchange is trading somewhere between 400,000 and maybe 2 million shares a day. And when we're scaling or when we're looking at where we're going to trade, we trade fixed blocks all day long, right? So we'll trade, if it's going to be a busy day, it's 1,000 shares of everything. If it's a slower day, we'll do like 2,000 shares of stuff. But I would never go out and try to put 10,000 shares directly into the market just because of that, because I would expect I'm going to get partial, then I'm going to wind up having to pull the market down. You know, if you look at what goes on, I mean, really, the best thing you could do if you're trading big block of shares is to put your limit order out there ahead of time, because if the $2 broker or somebody who's trading order flow, if they see that order sitting on the book, and let's say there's only, you know, let's say you're at $50.05 and your order's up at $50.20 for 10,000 shares, and this guy sees he's got to clear out maybe 1,000 shares to get to your 10. He's getting paid $2 a hundred. He's gonna clear out those other shares just to get to you and fill you. But more frequently, what we do in that kind of a situation is I'll go look for the blocks that are sitting on the, we're a little off, you know, but on the NYSE open book, I'll look for blocks sitting there, and then it's counterintuitive. People will say, oh, well, you know, I wanna fade that because there's a big seller up there, and I say, no, I'm gonna buy it because I know he's taking it up there because he's gonna want to make the money, right? Because that's how he makes business. That's how he's making a living. Anybody else? Yeah. Can you? Oh, I use, so generally speaking, I'll just go out to something like CNBC just to get the pre-market futures activity, because they do the implied open based on the, you know, I look at that data because they calculate fair value, they calculate the implied open. That's the piece of it I'll look for there. And then for news, for wire news, I'll use the fly on the wall. We've used Trade the News before, but you know, I find fly on the wall is sort of in the sweet spot for it's priced reasonably, it's got really timely information. They give you all the information that you need to check on why these things are gapping. You can see there's a pre-market mover section there that they have. You just go in there, you look at these 15, 20 minutes before the market, you can already see which ones are going to be earnings, and then really what you need to do is get it squared up so that you know if it's a 2SD gap. Okay, so I'm getting the coming close here, so let me just pop this up real quick. So here is the trade. So this was this is SFIX this morning. So this one gapped. So, and I couldn't remember the name of it when I just did the interview out there. It's Stitch Fix. I remembered SFIX, and I don't, you know, my relationship with these stocks is pretty short. So SFIX, what you're looking at here is the opening bar. So if you're watching this, then right away what you should focus on this first bar of trading here is I'm looking in and I'm trying to see where's the resistance? Where's this thing bouncing from? What's going on in that volume by price section? Where do we see thresholds that bounce the stock? So this whole first bar of trading, all I'm doing is trying to figure out where am I going to get in on those subsequent bars if it gives me an entry opportunity. So bar one, what I want to see is how high does it go? What kind of trade volume's going off? We don't have the volume going on here, or we can't see the ticker. We're always expecting the first bar of the day is where the overreaction is going to sort of continue. So this is where you get the news. Now you get all these people piling in because they think it's going to be a gap and go. They think this thing's going to the moon, and right by the time the second bar comes around, you start seeing people wonder about whether they made the right decision. So it's ticking slower. I'm watching the overhead here. I want to see is there support as well as resistance? Is it getting a place that it catches some bounces? We see this, right? This level right here is, if I can get it to, right? Sort of in that close of the first bar of trading and the open of that second bar of trading. It's, whoops, that's bad. I have to restart this. Okay, so I have to replay the beginning of this, but essentially I'm just looking to see every little inflection that this thing has in that first bar, is something that I'm looking at. I'm not having to monitor it constantly. So if I've got 2 of these up, 3 of these up, 4 of these up, what I'm really doing is just constantly looking over at that information on the right side of the chart, because that's going to change. It's dynamic. It's an algorithm. It's showing you, if you go on the montage, right, on the level 2 screen on Realtick, it's very much like the matrix in TradeStation, where it shows you the actual number of prints at every single price. This algorithm goes through, and it's essentially gauging the significance of the order flow that's happening at each level. So while you're watching this, right away you're trying to figure out, okay, where did it take off from? So when I'm watching this first bar, if now I see that closing tick on that bar winds up pushing higher really, really quick, then what I do is I look at the inflection level below that, I look at where it went to, and I say, you know what, if the subsequent bar gets me in, that's where I'm going to set a stop threshold, is where it shot higher from, because I'm not going to want to be a part of it if that's where there's order flow going on. But essentially now you're looking at the second bar, and you've already marked, I guess I can't mark, but down there where the, where this one closed and this one opened, that's where we keep seeing a bounce to the upside. So we just keep watching and watching and watching, and then you'll see here, I think, probably recorded where, so this time-lapsed, probably recorded where our order went live on this one. So if you look down towards the bottom of the bar, right, that first bar opened, and then you see that was the significant volume on that one. So opening print is usually like a big place to look for volume. What you want to see is that you have that pop on the histogram down there, because a lot of times you also get like an opening print that's not true, right? Opening print is just, 100 shares or 200 shares, and then 30 seconds, 40 seconds later, boom, the big print hits the tape, and that's really where the value zone was. Because that opening print can also be caused by, so you saw there, it just went live, right? So now you're short. So now initially, I'm just saying if it hits the top of that second bar of trading, if it gets up above there, I'm out. And right now, my target is down at the open of that first bar of trading. And there you can see why you don't want to do a market order. Right? If you did a market order, you wound up getting filled about 30 cents lower, and now the stock's tracking back up into the range. And the bad habit that people have is they look at where they got filled when they try to figure out where they should put their stops instead of where they should have been filled. So you put a market order in, you get a bad fill, and then you're like, holy cow, I'm down, down 30 cents on this thing already, and the rest of us are looking at it and saying, okay, we're down about 6 cents. And it changes the psychology of the whole trade. So now over the course of the morning, right, all we're doing with this thing, so our entry on this morning was 36.31, and initially the stop, the high of the first bar, 37.78, and then once we start drifting down into the range, we start ratcheting the stop down behind it. So that first stop is a volatility stop. You're just looking for where did it swing. And then as the stock begins to trend out and make its move, you start pulling in behind it. You use your volume by price data. I mean, you'll hear us talking about all this stuff as we're going through these during the day. But we're always ratcheting down. By this point in time, you're looking at this chart and you see that you've got all these opens, closes, high, lows are really overlapping there. That's a good indication. Then boom, we just pull our stop down behind it, and we let it trade in. Once it gets down to 50% of the target, I'm definitely pulling down right on top of that level, because that's where, if it starts moving higher, I'm going to expect to see it move back all the way up into that range. So everybody see why you got into this trade, or why you would have got into this trade if you were taking it? It's just like the example, right? So every day, there's at least 2 or 3 trades that pop up that look just like that classic example of this trade. And if you're watching this one materialize, now you start thinking about what's the psychology, right? What's the investor psychology that's going on? If you were the guy who bought the top tick and that stock started coming in, as soon as it got back down through that first bar of trading, you're already selling that stock. You're already doubting that it's a gap and go. As you start moving down through this volume, what you should be thinking is each one of these levels represents where somebody got in that first bar, because we're down. None of those subsequent bars ever traded in here. So all the volume we're looking at this thing picking through is prior entries to the long side. And as it moves down through there, right, the whole game is what's going on between people's ears. And as it moves down into that range, then what you're going to see is at each one of these heavy inflections that it's making, we see a little bit of a bump, and then ultimately, right, I'll be a spoiler and tell you, this one wound up moving right to that profit objective, went about 30 cents further. I don't care. So my thing is always plan it and then trade it. Plan the trade the plan, and then don't look back and try to figure out what you coulda, woulda, shoulda done. Just try to figure out, did it do what my method said it was going to do? Did it do an entry where I wanted an entry? Did I get an exit where I wanted an exit? Did I have a stop, a target, and an entry that all made sense? And then over time, these tend to just sort of play out in your favor. So I'm going to show you quickly. I'm going to go ahead here. This was the other one. This was DKS. This one opened, and the second bar was the entry. That's also one of the trades that we do. This one I can tell you 50% of the distance to the target, and then it moved back, got you out at break even. Those are the only two today. Over the course of the year so far, this strategy has had a lot of entries. So you've had 107 potential trades. Right, we've had 71 of this classic type that I'm showing you, this 1, 2, 3 kind of a pullback. That particular trade since January 1st has generated $50.29 per share traded of profits. Overall, it's done 67.87. These are the worst drawdowns that it's had to create this. So this number here is net of these numbers, and these are just the overall numbers that go along with the losing trades that it's had, right, because they all have losing trades. We've had winners, 75, losing trades, 32. And what's really interesting this year is longs to shorts, 53 longs, 53 shorts. But if you look at the long profitability, 24.76. If you look at the short profitability, 41.83, that tells me the market's feeling toppy. So I continue to focus on some of the short side. All right, so I think we can go back and look at that again. If the guys online, if any of you guys want to get so there's a 4-hour course that I developed that goes with this, and it comes with that scanner that I was showing you. You get a month of that. You get the course. It's 4 hours long. It's a lot of drill down into how we build out these models, how we determine which stocks we're going to take and which ones we're not going to take. I work through a bunch of trades live, and I'm just telling you why okay, this is what I'm thinking here. I think it's very valuable to know what somebody's thinking when you're learning from them. So I just go through, and for each one of the setups, okay, here's what I'm thinking here, here's what I'm thinking, this is why I'm doing this is why I'm doing that. And over the course of the 4 hours, what you get is a complete rundown of the 4 different entries that we look for, the 3 different exits that we look for, and then at the end of it, you get a ton of examples that you'll go through and work on a simulator without actually putting your own money on the line. Because I think that's super, super important. Like, you need to go and practice this stuff before you do it. It's not easy to trade opening gaps because it's very easy to detach yourself from the fact that things are happening rapidly on screen. But I think if you go through and you do the simulated trading, and you go back and you look at we've got all the scanner stuff archived going back a couple of years, then it makes it very easy for you to get your chops without having to go and risk a bunch of money doing these trades. So that's the link for it. If you're online, it's traderinsight.com/NYTE, as in New York Traders Expo. And for the people who are online, or for anybody really, if you're newer to this, we're going to include Stock Trading 101 and 201 with it. That's basically me explaining market dynamics, how markets work, and then in the 201, it's about how to use your brokerage software to structure orders and do these dependent orders and conditional orders and bracket orders and the kind of things that you can use to automate the trades. All right, who's got questions?